Good morning, everybody. Welcome to everyone who's on the line for our webinar today. This webinar that we're having today is the third session in a series on the subject of revitalizing exploration in Southern Africa. And this session today is focusing on the financing issues, whereas the previous ones we looked at focused on the legal issues and also on policy issues. So this is a very important series for us, and we hope that we're going to be able to keep this running going into the future, so as to be able to create a kind of a table for dialogue on this very important topic, where although we've still got a wealth of exploration targets in South Africa, it's very difficult for people to get into the exploration business, and we need to find out what those impediments are and see how they can be relieved. So our speaker today is Mike Seeger. Mike specializes in mining engineering with entrepreneurial flair, and he has experience both in the developing of mining operations as well as operational management of mines. He has an interest in establishing and funding of new mining ventures that are both profitable and sustainable. So Mike's talk is going to be about raising capital for the mining life cycle, from prospecting to mining in today's world. So with that, I'm going to hand over to Mike to give us his presentation. So good morning, Mike, and thank you very much for participating.
Good morning, everyone, and thank you for the invitation. Thank you for the invitation to speak, and I look forward to sharing with you my thoughts on financing of exploration and projects, the whole financing process from exploration to operations in South Africa. And I'm doing so on the basis of experience that of projects where I'm involved in financing of these. So I've structured this presentation webinar in 4 parts. Points of discussion. The first is fundamentals of developing and financing of mining projects. Second, I'm going to go specifically into South Africa, financing of mining projects in South Africa and the dynamics, the current dynamics. Thirdly, I'm going to look at case studies of current financings of mining projects. And then I'm going to come with a summary and recommendation for exploration in South Africa. So to begin with, the fundamentals of developing and financing mining projects. These are the basics that when we consider financing and revitalizing the exploration sector in South Africa, these are the fundamentals we need to bear in mind. So to begin with, we start with the mining business case. The mining business case is simply the process from resources and reserves to the customer, and the elements that lead to a successful mining business case. So I'm going to begin from the left. From the resources and reserves, we have to have these licensed, and ultimately we have to have a geological model with resources and reserves signed off by a competent person. Then we go into mining, open cast mining or underground mining or a tailings recovery project with a mine plan, a mining method, a process plant and a process plant design, a team, equipment and engineering, and sustainability. Sustainability is very important in today's financing, environmental and social sustainability. Then going from the mining and the process plant, we produce a mineral product, whether this is gold, whether this is a metal, whether this is a coal product. And this has specifications and we have to be able to transport this product to market. So the logistics component is a key element of the mining business case. The mining business case obviously is put into an economic model with CAPEX, OPEX, net present value, IRRs, paybacks. And ultimately, we need to have a credible off-taker, an off-taker that wants our product, and the off-taker dictates commodity prices that we receive. So the mining business case has to stack up if we want to secure and raise capital for mining projects. There's another dynamic that we need to take into account when we finance mining projects. In the middle, I've got a picture that is basically the stages of mine development from exploration to operations. So let me talk you through that. We explore. At that point, we have a geological model. We do a feasibility study, a pre-feasibility study, a feasibility study. We go into the design phase. At that point, we need to raise big capital for construction and then operations. To the left, you have the blue arrow, which shows you that as we go up the value curve, we increase in value. So the value of the mining project increases obviously from exploration to operations, whereas the risk, the highest risk is at the exploration phase, and the highest capital is really spent at a construction phase. So exploration is low capital relatively to the construction phase. So fundamentally, if you want to raise money for mining projects, whether this is exploration feasibility studies, whether this is construction operations, we need to have a strong mining business case. If we have that, we can secure capital. Now, let me talk about the capital types pertaining to the business case and the different types of capital that are available to mining projects. So there's equity finance. Equity finance really involves capital in exchange for shares in the project. Equity finance can take the form of also strategic partnerships where the junior miner partners with a larger company, and this will form quite a part of my discussion later on. Listing is a form of equity as well. This is not something that is very successful at this stage in South Africa, but I've nevertheless got it there. With the listing also comes a term called reverse listing, where we vend in our project to raise capital into a listed company. Project finance involves a debt facility with interest, with securities given by the project itself. It's got a term. The same with DFIs, which is development finance. This is typically money that also is willing to take a higher risk, a political risk. It's state-owned money. Then we have contractor finance, where the contractors are willing to finance mining projects on the basis of securing long-term contracts. This obviously only applies to contractors with finance. This would be mining contractors, processing contractors, even power plant EPC contractors. Then we have equipment finance, and then which is a big one, which is offtake, streaming / royalty finance, and we'll discuss this in more detail. So these are the types of finance that are available for financing the mining business case. Good. So having discussed the fundamentals of financing mining projects, now we go into the South African dynamics. And this is where we hone into the local situation. So let's go straight into minerals of interest in South Africa. And I'm taking a view of the future here as well, because capital looks at the future prospects. So one is EV metals and minerals, and this would be metals and minerals that are used for electric vehicles, as well as for renewable energy. So this is an important these are important minerals to focus on. Then, uniquely to South Africa, coal, because coal is the only energy mineral, or is the primary energy mineral for South Africa. And then we've got gold. So let's look at the dynamics, the mining industry dynamics, the international ones versus the South African ones. So internationally, there's a focus on EV metals and minerals. There's a focus on the new form of mobility, electric vehicles, the diesel driven engines are slowly coming to an end in the Western world in terms of their future. Obviously they will always exist, but electric vehicles are the way of the future, and that's where money is able and willing to spend on metals in that space. There's a gold bull market. Given the current situation with currencies, gold is seen as the investment destination of choice. So there's finance available for gold projects. Then coal. Coal, there's an active agenda to disinvest internationally. And this makes it very challenging for coal mining projects to find money, and unique methods have to be found. Coal, it's associated obviously with the whole carbon initiative and global warming. So coal is at a definite disadvantage. The next drive is for mechanization, automation globally in mines. And then the whole aspect of resource nationalization, also a very important component internationally. This is what's happening internationally. These are the main drivers. I may mention as well, obviously, the economic, the environmental and social sustainability forms part of that international drive, and it's a big component to investors as well. So having said that, let's look at the South African dynamics, uniquely to South Africa. There's an exit of major mining companies from South Africa. What does that mean? It means that the big mining teams, the capital, the systems that majors had and were present in South Africa, this is all leaving South Africa, with majors exiting. Reasons being, we've discussed this in the past, in terms of political uncertainty, the Minerals Act, those components that I won't elaborate in here, but major mining companies are leaving South Africa, which basically spells out difficulty to finance new mining projects. What does that mean? We've got junior miners, a lot of them that are undercapitalized. At the same time, we've got many old, large, mothballed mines, and these then are databases and can be databases for new mines to be developed. Another dynamic in South Africa is that we have coal as a major source of energy, and in South Africa, we have job creation requirements. So mining financing solutions need to be tailored around to South Africa. In the next slide, I am now discussing the different types of mining finance pertaining to South Africa and the dynamics. So those that are spelled out in the earlier slide, let's go through them. Equity finance. There's limited equity finance available. But the form of equity finance that's available to miners in South Africa are strategic, the The form of financing that's available to equity finance that's available to mining companies are strategic partnerships with larger companies, new larger companies. Listing in red, by the way, orange and red means difficulty, red means very difficult, green means good. So listings, no recent success stories. I wouldn't consider that as a real source of financing in South Africa today. Project finance, many banks are reluctant to finance, and there is very stringent criteria making it often very difficult for junior mining companies to find project finance facilities. The length of securing project finance, the systems, procedure, etc., is often not suited to junior mining companies and to the remaining miners in South Africa. So nevertheless, it's there, but it's a process with stringent criteria. DFIs, also, there is medium interest. Yes, there is money available. It's a long process, and I would also classify this as an orange source of capital, meaning not primary source, but yes, it is available. On the right is green. So this is where the capital sits for projects in South Africa, mining projects. It sits with contractors that are willing to capitalize mining projects in exchange for long-term contracts. Capital is recouped via long-term contracts. 2, and this is the biggest source of capital, which is offtake, streaming, royalty finance. And I'll go into case studies. So this is the biggest source of capital, and this is where projects have to be tailored to suit this type of capital in order to secure finance. Then equipment finance. Equipment finance is financing of equipment on the basis of, obviously, of operating mines, long-term contracts, but also available. There's a lot of equipment that needs a home, so there's sources of finance for that. Before I go into the case studies, I want to discuss these types of finance with respect to the project stage. And we have this seminar is about exploration, but you need to see the entire picture. So on the left, we have the column exploration, feasibility, design, construction, operation. And really, let's go down the exploration stage. The only type of capital that's available there, in my opinion, from my work, is our strategic money from equity money from strategic partnerships. And if the company is listed, I've experienced one of those where it's share rights issues. So it's only equity. There's no debt facilities. There's no offtake streaming facilities. There's no vendor finance vis-a-vis contract finance or equipment finance for exploration. So we've got to hone in that into the equity component only. Same counts for the feasibility and design phase. It's strategic partnerships and share rights issues. Once we get into construction, we're in the phase where we've done the feasibility. Then, of course, we have continued partnership opportunities, but it's really about project finance, DFI finance, offtake, streaming finance, and contractor finance with regards to build and operate and transfer contracts or royalty deals. And the most types of financing that are available are for operations, along the line of partnerships, project finance, DFI finance, streaming offtake finance, contractor finance, or equipment finance. So going into financing of mining projects in South Africa, we need to know this is what's available, and now we need to, our strategy in securing finance needs to take cognizance of this. So I'm going to present to you now case studies of financing of mining projects in South Africa. And these are, I'm not going to, obviously I'm bound by confidentiality with these, but I'm involved in these projects. And this is where money has been raised and can be raised in these types of projects. And then let's talk about what's available for exploration. So this is a project, it's an EV metal project. It's a vanadium titanium iron ore project. It's at a development stage. There's a mining right. There's a reserve of 50 million tons. The market, well, the product is vanadium, titanium, iron ore. And the market, who's interested in this product? It's metal traders that trade, it's metal trading companies that trade in the space of EV metals. And money is available for such projects. So this particular project was originally began as a much larger project, and it was sized down, re-engineered to a project where the bite size was good enough for the EV metal trader to put money into it, as well as contractors. So we're talking here of an open cost mining operation, mining a high-grade tertianiferous vanadiferous seam on strike. The material is then processed and then it is smelted. And the production rate is 20,000 growing to 50,000 tons a month. And phase 1 is 50 million rand, phase 2 is 700 million rand. And financing was done by the contractors and a streaming deal. The next financing case study is a coal mine at the mining right. It was in the project in the stage of construction, ready to start up. There's a reserve of 4 million tons. It produces export and inland coal for coal traders. It's an underground mining operation. It's crushing and screening, and there was at a later stage washing as well, but primary crushing and screening, 40,000 tons a month. The capital approximately 50 million rand, and the financing done was done via contractor finance, equipment finance, and offtake finance. The next project is a diamond project. So it's an operation with exploration requirements adjacent to the current operations. There's a mining right and a prospecting permit. And the reserves are 2 million tons plus, and the grades 10 to 30 carats per 100 tons. We produce premium diamonds. The market are diamond traders. Mining method open cast and a conventional diamond processing plant. Producing diamonds are produced from between 30 and 50,000 tons a month of ore. And the capital to start this small operation, 60 million rand. Again, it was funded by the contractor and a royalty finance deal. Next, we have the financing of an operation with the mining right, 50 million ton of coal reserve, and the commodity trading company is the off-taker for this particular product. An open cast mining fleet to the value of 60 million rand was funded via equipment finance. So what I'm presenting you here are projects that have been funded in South Africa, and none of these really involve equity finance for exploration projects. And this is our dilemma that we have in South Africa. So we have the exit of the majors. We have smaller mining deals that can be funded that are in operation or near operation. And now it comes to really the recommendations going forward, which is in the next slide. So first of all, the summary. A good mining business case can be funded in South Africa. All of these cases that I've presented, the finance was secured on the basis of the business case. So financing is focused on production or near producing mining assets. There's minimal financing for exploration. The current route for financing of mining projects in South Africa is contractor vendor financing, streaming, offtake, royalty finance, or equipment financing. The focus is also on smaller projects, higher grade mining operations. These are easier to finance. So this is a summary of my findings. And now we go into exploration. So I see 5 points to finance exploration projects in the future. South Africa has to focus on EV metals and minerals that are in demand for the future economy. These would be vanadium, nickel, titanium. Of course, the platinum palladium space is where the majors are already active. But for new explorers, this is what I would look at. And I would look at the undiscovered EV metal or to be discovered EV metal projects around the current, in close proximity to current metal mines. So the databases of mothballed and closed mines are the targets for the future. There's a lot of data there. There's very good data there. I would also focus on exploration near producing mines, because producing or near producing mines are attracting capital. And this brings me to point 4, which is partnerships with cash generative mines or strategic partnerships with majors, new majors. Often you find that major mining companies that are exiting South Africa still have a vested interest in exploring for new metals, and might be leaving South Africa on a larger scale, but the exploration aspect still remains intact. So this concludes my presentation, and I hope you are getting something out of it. Thank you very much.
Thanks very much, Mike, for a super presentation there. So we can open the floor for questions. If you have any questions, you can post them on the Q&A tab, as I said. Perhaps, Mike, you highlighted that really one's looking for equity finance for this. And I sort of look at that from the point of view of, if I was an investor and I wanted to invest in exploration projects in South Africa, the problem that I face is that there are very few to invest in. And, the implication is that if I wanted to invest in exploration, I would know that it's high risk, and and I know that very few exploration projects actually end up as mining projects. So I would need to diversify my risk by looking at a portfolio, but we don't have enough equity lists, enough exploration listings for me to be able to do that, and I think that's a big difference between us and, for example, Canada, where they have a very large exploration desk, where investors can spread their risk over many, many exploration companies. And although most of them won't come and yield any returns, there may be one in there somewhere that gives a serious return. So, that's it's a problem that we have. Coupled with, in Canada, they have these flow-through share schemes that encourage investment into exploration as well on the equity market. So, is the work that we need to do in that area here in South Africa?
Yes, I think Let's go to this particular slide. I'm going to go to this particular slide, and you, Alistair, you're raising the point of equity finance. On the top left, we have in South Africa limited equity financing options available, and nowhere near what Canada has to offer, particularly because of the different structures that they have available, the Toronto Stock Exchange, the availability of cash in the public market. At the same time, we've got a degree of political uncertainty in South Africa, which disencourages international risk money to come here. So I know that is being addressed, but what we need to look at now, what is currently available. What is currently available is we have the opportunity for strategic partnerships in the equity space. We've got EV metal potential. Where do those databases sit? So an example is in the past, Anglo Base Metals had a big database of projects that it recommended to the public to look at. This was many years ago. This was about 10 years ago plus, and encouraged people to look at the database and find the new projects or find hidden gems within the old databases. And whether this, whether Anglo would do this today is a different story. I don't know. But lots of large companies or that were active in South Africa have data, and this data can generate new exploration targets for South Africa. So it's very much a diligent process. New explorers or junior explorers going into these databases and identifying targets for exploration going forward. So we've got that. So what do we have? We've got limited risk capital, external risk capital. We've got the opportunity for strategic partnerships. We've got a new focus on new types of commodities, and we've got data. So these are the cards that we've been dealt with in. So that's what South Africa has been dealt with, and with these it has to work and kick off a new. Kick off the exploration sector again.
Thanks, Mike. So we've got a couple of questions coming through. The first one from Choso Khomatsang, who says, could you elaborate more on equipment financing in terms of how the exploration cost is then recovered?
All right, so I'm gonna go into this particular slide. So the two are unrelated. There is no link between equipment finance and recovering costs of exploration. The way you could, equipment finance only comes into place in the mining life cycle of operations. So the one way of recovering exploration costs, it could be that exploration costs are capitalized, form part of, if the project is successful, do form part of the bigger capital, and the repayment of the capital would then would cover equipment financing, but in essence, they're not related. They do not fit. There's no equipment financing linked at all to exploration. There's a financing model that's also available, is where exploration contractors fund exploration projects by way of executing the works in lieu of a stake in the exploration project. Obviously, only if the exploration project yields is highly prospective, and it's highly prospective because of the inherent data, historical data, because of its proximity to a large operation. So that's a form, but the two are not related.
Okay, thanks, Mike, for that answer. And then the second question that we have there is from Dineo Sefemo, who asks, how are you dealing with international impediments imposed on African governments, yet disadvantaging other areas of gain? For example, automation leading to loss of employment to locals.
Okay, let me deal with it. I'll put this slide up. So, in the opportunity fact of the matter is we need to create jobs in the mining business cycle, and what's happening internationally is that mining, open cast and underground, are being automated. The mineral processing is being automated, as there's a lot of automation initiatives in logistics, so jobs are being shed. However, if you look at where in the mining business value chain, where is the biggest component of value add financially? Financially, it is really in mineral beneficiation and in logistics. If you look at if you uncover the OPEX pie, the biggest cost component would be mineral processing. By far the biggest in most instances is logistics, followed by mineral processing, followed by mining. Those two would be maybe even, but logistics would be the biggest cost component, for example, for bulk commodities. Gold is different, but if you look at that value chain, you need to look at where are jobs being able to be created, and those are really in the mining space. The way that we see opportunities would be to have labor-intensive mining methods feeding into high-tech mineral processing plants. So a model in India is that the size of trucks that are allowed in an open pit mine are limited to a certain tonnage, cannot go beyond, for example, beyond a 60 tonner, in order to have more open cast trucks in the load and haul operation. That in turn leads to more jobs. So in the mining space, we can create jobs. In the processing stage, because we want to get the higher value commodity out, we want a high grade, we want to create a superior product. I don't see many further job creation opportunities there, but I do see that in mining. And we do not necessarily, by creating more jobs, compromise the mining value chain is not necessarily compromised. In fact, it has a big, the social dynamic is improved, the buy-in by the community is improved, and that in turn satisfies and reduces the risk for the investor. The forms of capital that are displayed below.
Okay, thanks. I think that's all of the questions that we've got there. Oh no, here's another one. Let me just read it. This is also from Dineo. The international coal disinvestment is an interesting area of discussion. As you have mentioned, it is the primary source of energy for South Africa, and so is the case for Botswana. International major financiers are pulling funds away So, for example, what can government do to emphasize the need and relevance at this point in time, adopting some technologies like carbon capturing, which were not in the project plan, but could be affecting the operation negatively, and some states are already signing signatories to these Paris agreements.
Good. So, very, very good point. And in one of the projects that I'm involved in, this particular topic features heavily. So, you're absolutely right. There's internationally coal disinvestment, and at the same time, we've got in the Southern African area coal as a major source of baseload energy. So let's go back into the mining business case and the types of finance with reference to coal. Banks are, if we see the different pots of finance at the bottom below the mining business case, we go through them and I discuss with you how to deal with it. Equity finance, the only form of equity finance would be a strategic partnership, but I wouldn't count heavily on it. Listing is a no-go. Project finance for most commercial banks is a no-go. African focused banks, but don't count on it. DFIs also lukewarm, no-go. Where's the money? The money sits in the offtake finance, it sits in equipment finance, and sits in contractor finance. Adding a carbon capture business case to this, the business case, obviously is extremely expensive, and at the moment, given the lack of appetite from the financing sources that I mentioned, I can't see financing yet of carbon capture at the moment. I only can see financing via offtake finance, equipment finance, and contractor finance. The problem is that African countries want to see an equity component. Projects need an equity component. So how do we slice a coal project up in order to get the entire value chain funded, from mining to processing to logistics? So you could have the mining contractor finance the mining equipment against a long-term contract. You can have the offtake finance, financier financing the process plant against a discounted coal, a stream of coal for a period until the capital is recouped. And equipment financiers coming into play as well, supporting mining equipment, power plant equipment, haulage equipment. This is the way coal projects can be funded at the moment. And carbon capture, I think, would play a role once equity financiers are willing to engage in it. But I have not encountered this in South Africa yet. But it is something for the future.
Thanks, Mike. I think I mentioned in one of the other sessions, we had a presentation from the Fossil Fuel Foundation, and they showed some very promising research work that is being done on being able to do carbon capturing and to be able to reduce emissions from coal-fired power stations, but it obviously will come with a pretty hefty cost, which one would then presumably be able to offset against carbon tax and so on. So there's a lot of techno-economic feasibility work still to be done in that area, but it's very, very important for us with the amount of coal reserves that we've got in Southern Africa that we can find solutions to that. There's another question. It comes from Choso again. Is there growth in exploration compared to the past, now that the majors are leaving South Africa. Yeah, and then it says contribution to SA GDP now and in the future. Is there an increase in that?
No, the answer is no. The biggest source of exploration in the past was from major mining companies that had big exploration budgets. So unfortunately, we're sitting now with a junior mining sector that has the responsibility of exploration, but limited capital available, and hence my sort of recommendations for explorations in South Africa is that we got to get back to strategic partnerships with majors. The majors were the main financiers of exploration in South Africa, unfortunately, that exploration budget, or the exploration activities have and that spend has reduced significantly. Alistair, you will recall the first presentation of your series, where we compared South African exploration versus exploration in the Congo and in West Africa, and you can clearly see that it has reduced. And this is the whole point, is to revitalize it again.
Yeah, absolutely, and hopefully, as we carry on, as I hope in the future, we can stimulate that. So here's another question that just come in from Tlabiwe Karabo. Exploration work seems to suffer from financing, more especially project financing. How do we convince entities like banks to start financing exploration?
I'm afraid that won't happen. So the only way that the banks would fund exploration would, in essence, be financing as part of financing a mining operation, and a going concern mining operation. There would be a capital allocation for exploration within exploration. Bank financing means debt, so it's got to be repaid. It's a loan with a repayment obligation. So a bank would only fund an exploration campaign, in my opinion, if it were to be presented by a producing mine that has the ability to repay that debt. So you will, in Canada, you will also not get a bank financing exploration. So that will not work, in my opinion. So it's got to come from the equity and strategic partnership pot, financing of exploration.
Yeah, I was associated with a company that we did eventually get up and running very well, but when we were looking for possible financing, and we were going to various banks with the mining right application and everything like that. Although we were trying to raise the finance for the actual startup of the mining operation, and the study was pretty robust, somewhere in the document on page sort of 57 or something, there was reference to having to do a small amount of exploration work, and that was the end of the conversation. It just did not go any further than that. And then from Dineo, does South Africa have a clear legislative framework, I guess, for radioactive mineral mining, for example, uranium?
According to me, it has that. So I can't cite that particular, but yes, it does.
Okay. All right. So that's all of our questions, all answered. With that, thanks very, very much, Mike, for your presentation and addressing all the questions that came through. And thank you very much to all of the people, the attendees, and the questions.